So imagine you buy an ounce of gold today.
Right.
It's just sitting there, it's shiny, it's heavy.
Yeah, the classic image.
Exactly. And then tomorrow, inflation shoots up, the economy gets a little, shaky. And as a result, your gold goes up in value too.
Right, the traditional safe haven response.
Right. So you check your portfolio, you see those green numbers ticking upward, and you smile. You think, I made the right call. But what if I told you that despite those green numbers, you might have actually just lost money?
It sounds completely counterintuitive, I know, but honestly, it's one of the most common traps investors fall into.
Yeah.
Because we have this deep-seated assumption that gold is just this completely static, 100% risk-free safe haven. Like it's treated like this ultimate financial fortress. But the reality is, it's far more complex than that.
It really is. And that's exactly why today we are taking a deep dive into the actual mechanics of investing in gold.
Which is so needed.
Right. We're pulling from some really fantastic, highly detailed sources for this. Specifically, there's this comprehensive analysis from a piece titled, What Could Go Wrong with Gold? By Doug Young.
Yeah, that's a great piece.
And we're looking at that alongside insights from a gold IRA company's comparison resource guide.
And just to give some context on Doug Young, he is a former financial director with over 20 years of experience in the markets.
Wow, 20 years.
Yeah, heavily specializing in evaluating gold IRAs, actually. He's evaluated over 80 of them. So we have some serious institutional knowledge to unpack today.
Okay, let's unpack this. Our mission for this deep dive is to basically break down that whole safe haven illusion.
Right.
We want to show you the real mechanical risks involved, the hidden traps of things like paper gold, and how to intelligently structure your investments so you aren't caught off guard.
Because to truly benefit from gold, you can't just know what it is. You really have to understand the invisible forces pushing and pulling its price every single day.
Exactly. And the first major force to understand is, well, market volatility.
Oh, absolutely.
Because we often hear that gold is somehow detached from the chaos of the regular stock market.
Yeah.
But the data just proves otherwise.
It does. Gold is actually highly volatile. It's
Yeah.
essentially a barometer for global financial anxiety.
A barometer for anxiety. I like that. And looking at the 2008 financial crisis makes that incredibly clear.
Right. Yeah.
When traditional markets were just melting down and sheer panic was setting in, everyone flooded into gold. They wanted that tangible safety, right? And prices just skyrocketed.
Of course.
But the fascinating part to me wasn't the spike. It was what happened after.
That is the critical mechanism to understand right there. Because what happens when the panic subsides?
Right.
When economic stability starts to return and investors feel, confident enough to jump back into stocks or real estate, the massive demand for that golden safe haven just evaporates.
It just disappears.
Completely. Consequently, gold prices can drop with violent speed.
Yeah.
And this rapid fluctuation, it can happen within a remarkably short window.
So if you are a short-term investor who suddenly needs to, say, liquidate assets to cover an emergency right as the market is recovering,
You could find yourself taking a massive loss on an asset you thought was invincible.
it totally shatters the idea of gold being this immovable object.
It really does.
And that brings us back to that scenario I mentioned at the top of the show, the inflation trap.
Ah, yes, the inflation shield myth.
Right, because gold is pitched as the ultimate inflation shield.
Ah,
But it's not a magic spell. It all comes down to the brutal math of purchasing power.
precisely. Let's walk through the specific mathematical reality of that.
Okay, let's hear it.
Imagine you purchase an ounce of gold today for $2,500.
Okay, got it.
Now, let's say the inflation rate rises by 5% over the next year.
Which isn't unheard of.
Not at all.
Eh.
And because inflation erodes the underlying value of the currency, literally everything, groceries, gas, housing, it all costs 5% more.
Right.
Therefore, for your gold investment to simply break even, just to allow you to buy the exact same amount of groceries you could have bought a year ago, that gold must appreciate in value by at least that same 5%.
It's like running on a treadmill.
Oh, that's a good way to put it.
Yeah, if inflation speeds up the belt, your gold investment has to run faster just to stay in the exact same place.
Exactly.
If your gold only goes up by 2%, but inflation is running at 5%, your portfolio might look bigger on paper.
Right, the green numbers you mentioned earlier.
Yeah, you might think you're winning, but in reality, you've effectively lost purchasing power. You're actually financially weaker than when you started.
What's fascinating here is that there is still a systemic silver lining.
Oh, okay, what is it?
Well, there is frequently an inverse relationship between the value of a fiat currency and the price of gold.
Okay, tracking.
When a currency's value drops due to rampant inflation, the market naturally demands more of that weakened currency to buy the same ounce of gold.
Ah, so the price steps up.
Yes, that reactive mechanical relationship is exactly why gold maintains its reputation as an inflation hedge, even though it isn't perfectly immune to the volatility we just discussed.
Okay, so if gold is essentially this barometer of anxiety, what triggers the anxiety in the first place?
Well, it's a lot of things.
Because we aren't just talking about abstract inflation spreadsheets, right? We're talking about global human behavior.
Absolutely. Wars, sudden political instability, massive shifts in trade policy.
Yeah, these geopolitical shocks that create instant worldwide uncertainty.
And when uncertainty hits on a global scale, the capital markets react instantly.
Like reflexively.
Yeah. Investors pull their money out of border-dependent businesses and emerging markets, and they seek the oldest form of tangible security on Earth.
Which causes that sudden, desperate rush.
Exactly. Unpredictable, massive spikes in the price of gold.
But again, I keep coming back to the snapback effect.
Right.
Just like the 2008 economic crisis, once a geopolitical tension stabilizes, or honestly, even if it just drags on long enough to become the boring new normal, the sheer panic fades.
People get used to it.
Right. And once the panic fades, the premium on gold evaporates.
It does.
It just seems like building a long-term financial strategy purely around hoping the world stays in a state of constant crisis is well, a terrible idea.
It is a terrible idea. You cannot rely on permanent chaos to sustain your portfolio's value.
Yeah.
But here is where the conversation takes a massive turn.
Oh, boy.
Because that inherent volatility is drastically compounded by the actual format in which you choose to hold your gold.
Right, the format.
This is perhaps the most vital distinction in modern investing. When people talk about buying gold today, they are rarely talking about physical metal.
They aren't.
No, they are overwhelmingly talking about paper gold.
Here's where it gets really interesting because the sources dive deep into things like gold ETFs, exchange-traded funds, and gold futures.
Yeah.
And I have to admit, reading this totally stopped me in my tracks.
A lot of people are shocked by it.
Wait, so if I buy a gold ETF, I don't actually own a bar of gold?
Not at all.
I just own a digital receipt promising that a massive financial institution somewhere in New York or London supposedly has it in a vault.
That's exactly right.
With an ETF, I'm trading the security of a physical asset for the convenience of a digital ticker. That feels like it completely defeats the purpose of buying a tangible asset in the first place.
If we connect this to the bigger picture, you are hitting on the exact structural flaw of paper gold.
Thank you. I mean, it just seems so risky.
What you are describing is known as counterparty risk.
Counterparty risk.
When you hold paper gold, you are relying entirely on a counterpart, the custodian bank managing that ETF, or the clearinghouse handling that futures contract to fulfill their financial obligations to you.
Right.
Your investment is tied directly to their solvency, not just the spot price of gold. If that institution faces a liquidity crisis or goes bankrupt, they could default.
So I'm taking on the inherent volatility of the gold market plus the systemic risk of a specific banking entity failing.
Exactly. You get both risks.
Yeah.
And the scale of this is mind-blowing. The daily volume of paper gold traded globally utterly dwarfs the actual physical gold that exists above ground.
Wait, really?
Oh, yeah. If every single person holding a paper gold contract suddenly demanded physical delivery of their metal tomorrow, the entire system would freeze.
Wow.
It cannot physically happen.
That is terrifying. And on top of that, you have leveraging.
Yes, leveraging.
The sources point out that paper gold is heavily leveraged, which means people are essentially borrowing capital to multiply the potential return of their investment.
Exactly.
And I get the appeal, I really do. It amplifies your gains if you guess the market direction right. But if the market turns against you even slightly, it drastically amplifies your losses.
Massively.
You could get a margin call and get completely wiped out on an asset you bought specifically to feel safe.
Yes. The mechanics of leveraged paper gold turn a defensive asset into a highly speculative offensive gamble.
Which is wild.
Which is why transitioning from paper promises to physical reality is usually the logical next step for an investor who truly wants to protect their wealth.
Makes sense.
If paper gold carries systemic counterparty risks and the market itself is volatile, the obvious answer is to just buy the real thing.
But the sources make it very clear that just buying the real thing opens up an entirely new logistical puzzle.
Oh, it's a huge puzzle.
You don't just buy a pirate chest of gold bars and bury it in the backyard.
I mean, you shouldn't.
The logistics of buying, authenticating, and selling physical gold are intense. There's a huge mechanical difference between buying standard 1 ounce coins and buying a massive 400-ounce gold brick like you see in the movies.
It entirely comes down to liquidity and authentication.
Okay, break that down for me.
Let's say you need to free up $5,000 for an emergency. If your entire gold investment is locked up in a single massive bar, you can't just saw a piece off and hand it to a bank.
Right. No one is accepting gold shavings.
Exactly. To sell a large commercial bar, the buyer often requires it to be assayed,
Assay. What's that?
which means literally melting it down or drilling into it to chemically prove its purity before they will pay you.
Oh, wow.
Yeah, it's a slow, expensive process.
Whereas if you own standard, widely recognized 1 ounce gold coins like American Eagles or Canadian Maple Leafs,
Yep.
you have total flexibility.
Total flexibility.
You can easily sell exactly the amount you need when you need it with almost no authentication friction because the coins are universally recognized and easily tested.
Precisely.
Okay, so coins are better than bars for the average investor.
Okay.
But once you have these physical coins, where on earth do you put them?
Well, this is where we look at the three primary storage mechanisms. And honestly, none of them are perfect.
There's always a catch.
Every option is a trade-off. The first is home storage in a personal safe. It offers ultimate convenience and immediate physical access.
But the risk there is obvious, right? Theft, or fire, or natural disasters.
Exactly.
And from what I read, standard homeowners insurance rarely covers high-value precious metals without a very expensive, specialized rider policy. So you're basically paying a premium just to sleep at night.
Exactly. Which drives many people to the second option, the bank safe deposit box.
Okay, a little more secure.
It offers a significant step up in physical security. But you are trading away your immediate access.
Because of banking hours.
You are entirely at the mercy of banking hours. And if we look at historical precedents, during times of extreme economic crisis, governments have mandated bank holidays where doors are locked for days or weeks.
Yikes.
If the banking system freezes, your access to your safe haven asset is completely frozen with it.
Which kind of defeats the purpose of holding it for an emergency.
It really does.
So that leaves the third option, professional vaulting services. These are specialized, highly secure facilities built purely for precious metals. They aren't banks, they don't do loans, they just guard metal.
Yes, and they offer comprehensive insurance and massive security. But the key mechanism to understand with vaults is the difference between allocated and unallocated storage, or segregated storage.
Okay, what's the difference?
In a fully segregated allocated account, your specific coins are kept in your specific box.
Okay.
If you deposit 5 specific coins from a certain year, you get those exact 5 coins back. They are legally yours, merely stored there.
That sounds ideal.
It is. Unallocated storage, on the other hand, means you just own a claim on a general pool of the vault's gold.
Oh, I see.
It's slightly cheaper, but it reintroduces a mild form of counterparty risk.
Right.
The premium peace of mind with allocated storage comes with premium ongoing storage fees, which of course eats into your overall returns.
Okay, so navigating the storage is a headache. But how do we navigate the volatility when we are actually buying the physical gold?
Or the buying strategy.
Because if the price is swinging wildly based on geopolitical anxiety, how do I avoid buying at the absolute peak? The sources outline a mechanical strategy for this called dollar cost averaging, or DCA.
Dollar cost averaging is the primary defense against market timing.
Okay.
The methodology is simple. You invest a set dollar amount, say $500, at regular, predetermined intervals, maybe the first of every month.
Right.
And you do this completely regardless of what the spot price of gold is doing that day.
It's like buying your favorite artisanal coffee beans on a fixed monthly subscription.
Okay, I like this. Let's hear it.
Let's say you budget $40 a month. Some months there's a drought. The harvest is bad and the beans cost more. Your $40 buys a little less coffee.
Right.
But some months the harvest is great. The market is flooded, the beans are cheap, and your $40 buys a lot more.
Yeah, that makes sense.
Over the course of a whole year, you end up getting a really fair average price per pound for your coffee without ever having to stress out over the weekly agricultural commodities market. You just enjoy your coffee.
The coffee analogy works perfectly for the basic mechanics of averaging the purchase price. By spreading out your capital, you flatten the curve of volatility.
Right.
But I'll add a layer of nuance here. The coffee analogy falls a bit short on the psychological side.
Oh, how so?
Well, coffee doesn't suddenly jump 20% in price overnight because a war broke out.
Fair point.
With gold, dollar cost averaging is less about simple budgeting and far more about psychological survival.
Psychological survival. Wow.
It completely removes the terror and the financial devastation of accidentally dumping your entire life savings into gold on a Tuesday, only to watch the market correct by 15% on a Thursday.
That would be horrible.
You accept that you won't buy at the absolute bottom in exchange for guaranteeing you won't put everything in at the absolute top.
Okay, we've covered a lot of defensive maneuvers. We know to avoid the paper gold traps, we know to buy liquid coins, we understand vol storage, and we have DCA to protect our sanity.
That's the defensive side.
But playing defense is only half the game. Gold can't be your entire financial personality. To actually build wealth, you need to know how gold fits into your broader offensive financial strategy.
And the foundational rule of any offensive financial strategy is asset diversification.
Right.
Gold is unique because it lacks the growth mechanics that traditional assets provide. Gold does not produce a quarterly dividend.
No.
It doesn't innovate, it doesn't hire a new CEO, it doesn't have corporate earnings. It just sits there.
It's just a rock.
Exactly. Therefore, a robust portfolio actively mixes gold with stocks for aggressive corporate growth, bonds to provide regular, stable income, and perhaps real estate to generate passive rental income and long-term appreciation.
It's about building a team where every player has a distinct job. Gold is your goalie. It's your defensive shield. But a team with only a goalie is going to lose every game. You still need your offensive players to score points. And to make sure the team is playing well, the sources emphasize the need to monitor the broader macroeconomic indicators that affect the whole field.
Because those indicators tell you why capital might be shifting toward or away from your goalie.
Right.
We've already discussed how rising inflation pushes gold up. But another massive indicator to watch is interest rates.
Interest rates. Okay.
When central banks, like the Federal Reserve, cut interest rates, the price of gold frequently rises.
Why is that? What's the mechanical link there?
The mechanism is called opportunity cost.
Opportunity cost.
Because physical gold doesn't yield any regular interest, it inherently costs you potential income to hold it, compared to holding a safe, high-yield government bond.
Okay, that makes sense.
But when the Federal Reserve drops interest rates, the yields on those new bonds drop with them. Suddenly, the bonds aren't paying much either.
Oh, I see.
So the opportunity cost of holding gold shrinks dramatically. Since you aren't missing out on massive bond yields anymore, gold becomes a much more attractive place to park your capital.
So what does this all mean? Let's follow the logic here.
Sure.
If I know for a fact that falling interest rates reduce opportunity cost and boost gold prices, shouldn't I just constantly watch the Federal Reserve like a hawk? And the second I suspect they are going to announce a rate cut, I just dump all my liquid cash into gold to front-run the surge.
This raises an important question, and it's honestly the exact trap that destroys amateur portfolios.
Really?
What you are describing is trying to time the market.
Yeah.
Why doesn't everyone do that? Because the market is incredibly forward-looking. Massive institutional investors with supercomputers are pricing in their expectations of a rate cut weeks or even months before the Federal Reserve ever steps up to a microphone.
So by the time I hear about it on the evening news, the price of gold has already adjusted to reflect that expected cut.
Exactly. And if your timing is slightly off, or worse, if the Fed does something unexpected like holding rates steady when everyone expected a cut, the market violently recalibrates.
Oh, man.
And your mistimed all-in gamble leads to heavy losses. This is precisely why relying on the slow, methodical strategy of dollar-cost averaging and adhering strictly to a predetermined asset allocation is the only sustainable path.
Which brings us to the ultimate question. What is the actual number for that allocation?
The golden rule.
Yeah. If I'm building this diversified team, how much of my net worth should be locked up in the goalie? The sources give us the golden rule of allocation. Financial advisors generally recommend keeping anywhere between 10% and 20% of your total portfolio in gold.
That's the standard, yeah.
But figuring out exactly where you belong on that spectrum depends entirely on two deeply personal factors: your timeline and your psychological risk tolerance.
Timeline is paramount. If you are investing for a very long-term goal, let's say a retirement that is 25 years away, you might be perfectly positioned to allocate closer to that 20% mark.
Makes sense.
In that scenario, you are using gold strictly as a multi-decade hedge against unpredictable cycles of inflation and systemic economic shifts. You don't care what the price does next week because you have the luxury of time to ride out the short-term volatility.
But if your goal is short-term, say you are saving up for a massive down payment on a house and you absolutely need that cash in 12 to 18 months, you simply cannot afford the risk of gold prices dropping 15% right when you need to sign the closing papers.
Exactly.
For short-term goals, you require assets that are far more liquid and vastly less volatile. You need absolute predictability over theoretical protection. In that case, maybe you hold 5% or no gold at all.
Which perfectly ties into your risk tolerance.
Mm-hmm.
And risk tolerance isn't just about your mathematical capacity to absorb a loss.
What else is it about?
It's about your psychological endurance. It's your genuine ability to endure sharp, violent fluctuations in your net worth without panic selling at the bottom.
Right.
If seeing your portfolio drop by 8% in a single week due to a sudden geopolitical stabilization is going to keep you awake at night in a cold sweat, your risk tolerance is low.
Yeah, you have to know yourself.
Exactly. Your exposure to highly volatile assets like gold needs to reflect that reality completely, regardless of what the inflation spreadsheets say.
It really is a delicate balancing act between the hard math and your own mindset. We have covered a tremendous amount of ground today.
We really have.
We completely dismantled the myth of the static magical safe haven. We pulled apart the terrifying systemic risks of leveraged paper gold and counterparty defaults.
Right.
And we laid out the actual mechanics of defense and offense,
Mm-hmm.
from the logistics of authenticating physical coins and navigating vault storage to the psychology of dollar cost averaging and opportunity cost.
The overarching, inescapable takeaway from all of this analysis is that institutional knowledge is your primary defense.
Well said.
Gold is a remarkably powerful tool, but only when it is deeply understood and applied with surgical precision.
Right.
Recognizing the actual mechanics behind the price movements, the volatility snapbacks, the purchasing power math, the geopolitical anxiety cycles, allows you to structure your physical investments in a way that truly captures the protective benefits of precious metals without falling victim to the invisible traps.
As we wrap up this deep dive, I want to leave you with something to ponder on your own.
Oh, I love these.
We live in an increasingly, almost aggressively digital world. Our paychecks are automated direct deposits. Our daily purchases are contactless waves of a smartwatch. Most of our life savings are quite literally just invisible ones and zeros sitting on a banking server somewhere. It is all incredibly abstract and inherently fragile.
It is.
So, consider the deep psychological comfort of holding a tangible physical asset in your own hands. Does the ultimate value of physical gold lie not just in its daily spot price or its complex inflation hedging math, but in the profound, primitive peace of mind it brings by simply being something real, something permanent that doesn't require a password, a Wi-Fi connection, or a solvent bank to exist?
It is a deeply compelling question. And perhaps that underlying psychological anchor is the ultimate reason why, despite all the extreme volatility and logistical complexities we've unpacked today, humanity has remained so captivated by this single metal for thousands of years.
If you want to explore these complexities further and really examine how these storage mechanics, allocations, and specific strategies might apply to your own financial picture, there is a fantastic, highly detailed resource available to you.
Highly recommend it.
We highly recommend you go to the Gold IRA Company's Bulletin website for a wealth of related information, detailed company evaluations, and comprehensive market analysis. You can find them at goldiracompaniescompared.com.
It's a great resource.
I'll say it again so you can jot it down. Head over to goldiracompaniescompared.com. We have also made sure to include a direct link to this information right in the notes for today's deep dive.
Perfect.
Thank you so much for joining us as we unpack the real mechanical story behind investing in gold. Keep questioning the myths and keep exploring the deeper mechanics of your investments.